that as part of your analysis. I'm really excited about this new feature. It's just data mining, kind of a bunch of historical back testing automatically. So
I love that,
sorry
man.
to jump in on that, but I just want to get your thoughts on that, Chris.
No, that's awesome. That would be, I love those polls and studies, because what's funny is a lot of those would be, anything can happen in a 1 to, let's say, 30-day window. But when you look out 3 months, 6 months, 12 months, I mean, everything is noise. And if you give the market time, we're probably going to be fine. I mean, silver bounced back hard. It's up, almost 8% today. What are your thoughts on silver right now, Nick? Do you think that this is we hit the 21 period moving average all in one day? We had a 15% correction from top to bottom. I was tempted to throw a couple $1,000s at this yesterday and just let it run, or put a couple like silver option trades in just for a short-term income trade. I still think, look, what talked me out of the trade is the fact that we had a 3-year profit that I collected this year near all-time highs. And once we had that 10 to 50% correction right here, I got back in with another stake, and that stake is up 80+%. So it's like, why am I adding more right now? I don't really have to. It's like, I'm still in the game. I've got some vested interest and some skin in the game on silver. And I kind of want to see how this whole thing plays out, because, if we go down and then right back up to a lower high, come back down again, that's going to squeeze out and flush out a lot of the loose hands and a lot of leverage. And then we see where this kind of, pullback is really good for. Technically speaking, we're due for something. I mean, this is 80+% to the upside, a chart that's gone parabolic for 5 or 6 straight weeks, if I'm not mistaken. This is silver. 1, 2, 3, 4, 5 straight weeks up, and go monthly. It's probably even more than that.
Yeah.
Oh, baby. Look at this thing on the monthly. 1, 2, 3, 4, 5, 6, 7, 8 months in a row of silver up. I mean, typically like a 7 to 10 candle sequence is usually what I'm looking for. So we're 8 months solid green with tons of upside. I don't know. I just think let the market give us some structure. There's no hurry to jump and chase silver, in my opinion. Right now, I feel like you've got some of the speculators and FOMOers that are chasing silver right now. And that's just rarely ever me. So did you throw anything in short term on this little pullback yesterday?
So I didn't do anything on silver, but
Okay.
I did buy a little bit. I added a little bit more to my gold position.
I saw that. Yeah.
Chris, I'm sure that you know this as well as I do, but I've been watching that gold silver ratio for years.
Yep.
XAU, XAG here for those of you guys on TradingView. You can pull this up on your own. So kind of an interesting scenario is I was playing around with this yesterday in my video. I did a what is it, a regression line? Let me see. There it is. Regression trend. I just threw a regression trend on this, and I thought it was interesting. For a long time, I have been more preferential to silver. Like, buy silver, it's the better buy. I know we've talked about that a while. For the first time, I actually feel like, now actually gold doesn't look too bad. Like, gold actually looks relatively, I don't want to say cheap versus silver, but cheaper than it was. I mean, back in COVID, Chris, we were talking 125 ounces of silver to get 1 ounce of gold. Now you're talking about 56. We have really shifted where the crowd loves silver. And so I'm definitely with you in the sense that, you've been playing silver. I've been playing silver. I've owned physical silver and in my portfolio silver for years. I know you've also traded it. And so I feel, vindicated for sitting around on something that hadn't moved for a long time. To see it make this move. But I'm with you in terms of like investing in it. There's nothing for me on an investor side up at these levels. I feel like, if you wanted to be long silver, and again, I could start playing around with my things here, but basically the idea is, generally speaking, after something makes a huge run up, the forward-looking returns, historically speaking, are usually not as good. That's what I'm finding in the data. After a huge run-up, typically the forward-looking returns are not as good as when you buy something when it's low. It's like the simplest concept, but buy low, sell high. On an investing standpoint, like 12 months out, you're typically going to get better returns. Not always, but on an average basis, you're going to typically get better returns buying something when it's low and beaten down and people don't want it on a 12-month out basis. Now, from a trading perspective, yeah, I mean, I threw in a little long on gold, as you mentioned, in the VIP room. I just added to my existing long position. I doubled the size of my trade, but my stop loss is still pretty tight. So if this thing were to, break through structure here today, then I'm going to just take take that off the table and just reset on precious metals. But crazy move last, couple days in silver to see 10% up, 15% intraday down, and then back up 7.5% today. Absolutely crazy.
Yeah. And to be fair, I mean, I do think that people, and I'm speaking like generally for people that have been holding gold and silver, everyone that's been kind of quietly accumulating and amassing gold and silver, you can include some of the doomsday preppers and people that have been anti-dollar for a long time. This has been an amazing year. But now we have leverage and funny money and FOMO that's coming into the markets to drive prices all over the place. Look, I think that there's some very real wealth that's been generated. Case in point is listening to some sessions with financial advisors that have had people that have, $100,000 or $200,000 in silver that is now worth double that, triple that, quadruple that. What do they do with it? Like, some people are like, I never want to sell my silver, and some people don't know what to do. It is, I think this type of gain is really providing a huge wealth cushion for a lot of people. But just like with everything else, like if you turn, 100 grand into 500 grand or 500 grand into millions of dollars or whatever it is, it's probably best to start doing something to preserve that capital and work with that capital, as opposed to still staying all in with that same stake where you're always invested in, you need silver to just continue to climb higher. I mean, look, let's go back to the old, what was the Doge Dog millionaire guy, whatever that, talking about.
Yep.
He took $180,000 of friends and family and credit card money essentially and turned it into like $2 or $3 million, and then went all the way back down to basically where he started. I think he's back up in the hundreds of thousands or maybe over $1 million, but probably not as much anymore. It doesn't matter. Point is, when you take, 180 grand, turned it into $2 or $3 million, he had people online, like big, like YouTube influencers that were literally like, you have this incredible story. What are you going to do with this? And he was like, I'm all in, dude. I'm just holding it. It's like, you can put yourself in like a different bracket. You can manage capital. And if you took, $1 million and found a way to make 10% a year on that, guess what? You've got a 6-figure income passively. You can do it with a low tax bracket. If you want to do anything long-term capital gains, you can have a 15% tax bracket. You can do pretty well. So it's like, you can change a lot of things for the better if you learn how to manage that wealth. So I wonder how that kind of wealth effect is going to play out in 2026, because now you have silly money, like I said, kind of jumping in and throwing things around. It's going to get a bit more volatile. Every time we've had huge runs in silver, by the way, we have had pretty nasty kind of, if not equal, corrections. And, again, it'll shake out the leverage. It'll shake out the loose hands. You'll be left with the convicted, or the conviction traders again. I do want to ask on SILJ, you have some junior miners here that, this has been the big question, because yes, we've had a run up, but it's been underperforming spot silver. And some people have been saying, well, because miners haven't run yet, they're calling the top, while others are saying miners still have a lot of room to go, so they will continue to grow with the spot price of silver. The nice thing is here is it's really cheap. SILJ is really cheap. It's $28. I mean, yes, we could pull back here. I'll tell you this, Nick, if this ever comes back to like $12 or $9 or $8, I'll buy it again, because even for the last decade, I mean, we've seen runs of 100+% going from like 9 to 20, 10 to 20. Now that we're in this kind of new atmosphere, like, do we go from, do we pull back to 20, go from 20 to 30, 20 to 40? Can we double like we've been doing for the last decade? I don't know. Part of me feels like I'm just late to this whole thing. Like, even having a 3-year position, now it's like uncharted territory. Do we really see silver and gold, which also, if you ask me what the U.S. government wants to see, do you think the U.S. government wants to see higher prices of gold and silver?
Probably not. It makes the dollar look terrible.
Exactly.
So
and
Chris,
I do think there's a lot of potential like regulation stuff that could come into, I guess, disincentivize people from holding gold and silver or spot trading it like we do on some of the paper trades.
Well, I know a lot of the was it the COMEX or somebody changed the margin requirements on silver?
That's always like one of the first things. If they change margin, it's like, I would be very cautious, because it makes it really expensive to then throw it in, and people get over allocated, and you're just stuck with like, now I can't afford to do anything other than, hang on to this drawdown.
Yeah, here's my thought on it, Chris. So I was watching a video yesterday. I'm a physical stacker. I don't know if anybody in the audience is a stacker themselves, but I like to stack like physical silver and some physical gold. I don't have a ton of it, but I like to have some physical precious metals. I think it's number one. I think it's cool. Number two, I just think it's a practical thing. So, anyways, the reason I bring that up is I sometimes watch content in the physical silver stacking, gold stacking community, and
Okay.
the dealers are completely caught off guard by this. So people who
Sure.
deal in precious metals, like, you got to think, like, put yourself in the headspace of somebody who has to buy physical silver or physical gold from people or sell
Mhm.
physical gold. So anyways, this price move has happened so fast that the people at the dealership and wholesale buyers of precious metals, smelters, or the places where they smelt it down and stuff, the physical world of silver is sort of like confused with what to do with this. Put it this way, if you go to sell physical precious metals, they will not give you spot price for your silver or
Not
for
even
your gold.
close.
Yeah,
Yeah.
they will give you, I think, somewhere in the neighborhood of $5 to $10, at least from what I understand, below the price. Now, I have gone into shops physically before, and they will pay you, $1 to $2 less. So we are seeing this premium because there is a cost of holding for dealers. They
Sure.
can't just liquidate it on the market because they have to physically hold on to it. There's a risk. They have a store location. There's real world costs. That's why they have premiums involved in the physical precious metals. We're talking about the paper market when we talk about this stuff on, live stream. The physical market is not sure with what to do with these prices. And so what they're doing is, if you want to go sell it, you got to sell it way less than what it's actually spot priced at, because the volatility, right? Chris, you know this very well. The options market, they're saying this thing is moving 5-10% a day right now. If I take it from you, if you come in and sell me your physical silver and I pay you the full value of it, tomorrow I could be sitting on a huge loss because I just bought, $10,000, $100,000 worth of physical silver. Anyways, what that tells me, without saying it, is that people are looking at this with squinted eyes. They're looking at this move and they're saying, that seems pretty unsustainable. And I don't think the market really cools off on precious metals unless you stay in this range. Like, if you actually start to kind of stick it out here, we go sideways for a little bit, or maybe a little down, or, kind of but it seems like the market is poised for this kind of move, Chris, at least right now. I'm not betting on that. I'm just saying that's what it feels like.
We'll see. I mean, typically what we don't see is the market have a sideways correction, something that goes up parabolic. I mean, 80% in 3 months, 4 months is typically not going to end with just a bull flag, right?
Sure.
Typically what's going to happen is you're going to go up 80% and you're going to pull back probably, half of that, if not all of that. And, again, like, that's really ugly. And that is the biggest outlier risk of anybody that's trying to get into silver with this intention of, like, silver's going to $150, silver's going to $200, gold's going to 5,000 or 10,000 an ounce. That might happen in the next 5 or 10 years. I think what everybody was surprised by this year is how quickly this trade was looking good technically, gained momentum, and just accelerated that momentum. That's what I think caught everyone off guard, was like, holy crap, gold is the best performing asset. Silver is outperforming that. And now we're talking ETFs where, you literally are seeing, JP Morgan talking about, instead of doing a 60-40 bond portfolio or a 60-40 equities bond portfolio, you're talking 60-20-20. I see some smart, 3 and 30 hedge funds out there talking about a 60-30-10 for a 60% equities, 30% gold, silver mix, and then 10% Bitcoin. Like, that's very different than the traditional 60-40.
Well, and if we just look really quick, I've got a 12-month chart pulled up. The reason I pulled this up is we don't have that many scenarios, guys, where we've had moves like this. So if we were to just you could do all the back testing you want. You really only have a couple examples in history to look at. So we could do them. The last time we had this kind of move, let's call it 100% move or greater, was in 1 year. I mean, let's call that's pretty close. 80% plus, January 2010. We proceeded to launch much further in the following year, and then we had a blow off top. So then we could go back over here in 79, right? That's where precious metals went absolutely parabolic, 370+% in the year. What happened next?
Blew it off again.
Launched higher by another 70%, blow off top, and a crash. So,
which, by the way, look at that year, Nick. Go from
yeah,
that 300 set. Look at that gap to go from year end to year start. Like that's, I mean, again, we're talking what 40 years ago. So, I mean,
sure.
things are obviously a lot different than the modern market like we have now. But could you imagine what is that jump, by the way, from year end to year beginning? That had to
is
be like a
35%, 36%.
yeah, that would
Yeah.
be incredible for like January 1 and then feel like absolute trash the rest of the year.
I mean, I got to say, if you get that kind of move, that's like
Right?
saying in modern day,
We're going
it
100.
leaps to 100,
Yep.
and then we go, you know, the
backfill the whole-
mania, and then you
Yeah.
have a crash. And
Yep.
again, if we're going off of history, let's say we only really have two obvious examples for silver to make this kind of move. Both scenarios, you had massive surge. To your
Mhm.
point, it didn't just sort of range bound or stay sideways.
Right.
It launched, it kept going. Nobody's going to be able to call the top on that. And then it absolutely tanked. We saw that happen again in 2010, 2011, where precious metals topped for multiple years, for a decade, really, decade and a half. And so I think, you know, if we're using history as a guide, that's kind of what it's looking like. I wouldn't be surprised if we launched up to 100 in the next few months, and then maybe you see some sort of large scale selling. But you know, that's anyone's guess exactly where the thing tops. It could top right now. You know, it's really hard
Sure.
to say.
And look, I think at the end of the day, if you're willing to look out 3 years, 5 years, 10 years, I think there's going to be dips and opportunity to stay long and maintain like a bullish outlook. I just don't want to be sucked into the mania that is we're up 165%. Maybe it has another 20, 30, 40, 50% blow off top. That's great. That's exciting. But if you are left as a bag holder at the top, the pain of watching, you know,
Yes.
all-time highs become a 50% drawdown. Like again,
I've got one more thing to add to that, Chris,
Yeah,
just
do it.
going off what you said, just because you just mentioned that. Keep going, but look at this. On my side, if we could show my screen for a second, the drawdown post, let's also, like, we may not know where the top is, but let's just talk drawdowns. Drawdown from the top, 92%. Drawdown from the top, 72%. So to your point, keep going. I mean, that's where you have, when this thing sells off, could get nasty.
Yeah. And probably can and will get nasty. And, you know, if you're, the hard part is think about what I just said as far as the allocation. I mean, these are actually for the market cap side, these are actually pretty small markets compared to the S&P, compared to even like Nvidia and Tesla, and individual stocks in the Mag 7 trade with far more volume than what we're seeing in silver. So options has blown up exponentially. Gold and futures have blown up exponentially. Again, that's a huge driver of underlying price, but nobody's going to love these trades if they're down 60 to 70%. Right. So I'm just saying, like, I want an allocation position, but I think going, I just heard somebody, it was a financial advisor that was talking, you know, he's like, I have conversations with people that are literally 50% silver or 50% gold, and the rest is cash. Like, or they're literally like 70%, 80% gold, silver. And it's been a blow, like just a blockbuster year where they're like, I never expected this. But like I said, is what are you going to do with that wealth? Because some people don't like to push the sell button. Some people never want to take profits on stuff like this because they think that it's just long run's going to go up. But if you put mania into this equation, that comes with a lot more volatility. And yes, it could benefit to the upside with this continuation. But you and I also look at charts and see this is not what normally plays out. And that's what I'm worried about, is like the normalcy. And like we have technical efficiencies and reversions, which every chart will have it. Every chart's going to have a reversion. And yeah, I mean, I don't care if silver's up to $150. It's probably going to pull back to any type of inefficiency. When you're looking at a yearly chart or a monthly chart, you're going to have pullbacks of probably 30 to 50%, probably on the minimum. I've got this chart up here on my side. I wanted to ask you about the Japanese yen. That's a big story for 2026. I think one interesting way to play this is, you know, that I kind of always crap on the yen as far as like currency trading, because it's a very difficult pair to trade unless you trade what you see. But I don't want to hold positions on it because of negative swap. Yes, they're raising rates, but they're still below most of the other rates in the currency world. But one way I could trade it is going long FXY. If this is a range where the Bank of Japan is going to come in and kind of prop the yen up and prevent it from getting weaker, you know, if I can make like $7 a share, and if I measure this move potentially up to about $16 a share, let's just talk about return on capital. If I hold a position that's going to cost me about $5,800, and I could turn that, let's just say I can make $10 a share. So I can make $10 a share. I have 100 shares out of a $5,800 position. I can make about a 17% return on that trade. That's not bad as like a little hedge. I looked at putting in something on futures and maybe playing the VIX a little bit for 2026. This is something I could have running in the background. This also is a risk-off hedge in my opinion. If the Japanese yen gets stronger, I do think that's going to have some risk-off tone in the market, because every time that we saw in 2024, that was a taste, that was a sample of what a strengthening yen can get us. And I mean, maybe it's so long ago, but I remember it like it's pretty recent, last summer. But this move was a 10% correction in the S&P, and it was a 20% correction in the Nikkei, all within about a 3 to 4 week window. If there is a little bit more sustainability to this, we could go from a 10 to 20% correction in the equities market. We could go from a 20 to 40% correction in the Nikkei. That's a nasty risk-off environment that has to be on people's radar as a potential like geopolitical risk or even like a monetary policy risk going into 2026.
Yeah, I mean, I think the yen is really interesting. Actually, somebody in the chat said Swiss yen. Let me just read that. Is Swiss yen a better hedge? No swaps on shorts right now.
No,
yeah, I mean,
because it's at all-time highs and it won't turn. Like, it hasn't turned yet.
Right.
If you bring up the Swiss yen, it's like look, Swiss yen, I've got some stories. But let's go back to 2015. Okay, 2015 Swiss yen. I got to go way back here. Look, this is what has blown me away about the Swiss yen. Okay, all-time highs going back almost 20 years was around 107.
Yeah,
we are literally talking today at 197. Why do I not consider the Swiss yen as a great short hedge? Because there's no sign of this market giving a crap about all-time highs.
Yeah.
So if it turns, sure, it's a good trade, but I wouldn't say it's something I would want to hold as a hedge. I would rather buy FXY, and worst case scenarios, I'm throwing $50, $100 with no swap and see if I'm right or wrong. But currencies can be very tricky, because if this doesn't break, and here's what I'll say on the yen: if the yen gets stronger, I want to see every single currency pair, Aussie yen, CAD yen, Swiss yen, Euro yen, Pound yen, Dollar yen, New Zealand yen. I want to see all of them go in the same direction. That's the only way that I will believe that the yen as a basket is getting stronger, because it's like, oh, the Swiss yen broke. And you look at every other pair and they're still sitting at highs. It's not the yen leading the charge. Like, that'd be a move on the Swiss. If it's the dollar yen breaking down, it's the dollar, not the yen. So make sure that when you follow the yen crosses, make sure you're watching the basket. If the entire basket is moving the same direction, there's some fundamental forces behind it.
Yeah, I think that's a good point. I think, I mean, you just look at the yen pairs over the last few years. They've been just a terrible thing to try and trade against the yen bearishness. I mean, we've been in a environment where we talked about this a lot here recently. Let me go to my real quick. We'll go real yield heat map. Yeah, this is interesting. So what you're looking at here, actually, this might be better. Real yield history. I know I showed this to you and a couple other people. If we look at the Japanese yen, what you're looking at in yellow is the real yield offered by Japan. The red line is inflation. The blue line is interest rate. So they are rising their interest rate, but you're still getting a pretty negative interest or real yield holding Japanese yen. This is part of the reason why people are so far away from it. Right. If you hold dollars, love or hate the dollar, at the end of the day, you are getting a real yield where CPI is 2.7, interest rates 3.75%. Funds are going to naturally flow in the direction of where they can get some positive real yield. That's why for the last few years, the Japanese yen has been so difficult to be long. Right. This plus a pretty risk on type of environment has made the Japanese yen just a terrible trade for a while. At some point, if they keep raising rates and perhaps other place starts cutting interest rates more aggressively to sort of administer to economic fallout, then yes, the yen could just be a monster for years on end. It's just tough to call when that will be.
Yeah, I was thinking with that chart you have up on the heat map, with that real yield, I would say if the real yield is less than 1% because of currency risk, because of exchange fees, if it's less than 1% from like real yield dollar to real yield yen, I feel like that carry trade is on the verge of showing us its teeth. Obviously, if it's 0.5 or 0%, then we're probably already seeing the markets playing the game of this unraveling of the carry trade. So keep an eye on that. Like that's a great chart to have in Edge Finders to look to see when that real yield is less than 1%. So if we have a positive 1 US and we have a 0 on the Japanese yen, I would be watching price action on yen crosses. If obviously the real yield of US goes down and the Japanese yen is getting less and less closer to 0, just keep it on that real yield. I think that's something that we can kind of keep a tab on, this like unraveling of the Japanese yen, versus what I just showed you on my chart, which is I just have to watch the yen basket. And it's like, that's a little bit harder to time, certainly time. But when we're looking at it from like just a real yield perspective, I think that's ultimately what traders and investors are watching, because even if you're borrowing in yen, and yes, they're raising rates and their 10-year yield is going higher, but if you're borrowing in yen and putting it anywhere else in the world, it is typically giving you a return on capital. So that's why the carry trade has been so popular here the last couple of years.
Yeah, and I mean, that's in the long run for the currency traders, that's the biggest game in town, right? Is the real yield play, is over long stretches of time. So yeah, I would totally agree with you. If that Japanese yen, if this number keeps getting higher and these other numbers start to come down, the Japanese yen could get real strong. So we do want to keep an eye on that, and I think that's part of the reason markets have been jittery here recently. And watching this, Chris, we have FOMC meeting minutes dropping here in about 4 minutes.
Okay.
Most likely, probably not going to be anything of significant substance, but every once in a while, you have the potential for big meeting minute shifts to take place. Do you have any thoughts in terms of indices and just general thoughts on the Fed overall as we turn the calendar year? You think the Fed's still mostly on our side going into 2026 in terms of wanting to be more on the quantitative easing side, wanting to cut interest rates? How likely do you think it is a surprise to the hawkish side next year?
I think the only way they turn hawkish is having inflation rear back up. If inflation climbs back above 3%, then the narrative from the Fed is going to be a little bit more firm. I think that, Trump making all these threats to Powell and saying he's going to fire him, and I saw a headline today he's going to sue him. It's like, whatever, dude. It's all a bunch of noise. But like Powell's out in May, so whoever is on the board, it's full of academics. I don't think it's going to be necessarily like a Trump stooge that's the Fed chair. But I do think that the reality is the inflation story will take away all of the power of the Fed and all the power of the government, because what's really going to matter is if prices get more expensive, hyperinflation or any elevated inflation will crush the economy. I think it's going to squeeze out growth, choke out growth. It's going to make people, start to budget. Even the top end of the K will probably start recognizing, like, how have we not improved this crap in 5 years? Like, inflation started COVID onwards because we gave people money, and there's a lot of money chasing less supply. We shut down the world, obviously, for 30 to 45 to 60 days. Some was way worse than others. We tried to get back to normal within about 60 days, and then we fought over masks and vaccines. Go to now, it's like we're 5 years of persistent inflation. Even if we get deflationary pressures here, Nick, let's say that CPI goes to 0. Prices are still elevated for the last 5 years. Everything we have in our life is more expensive, right? So even inflation at 0 means we're still at these levels of everything in life is more expensive. You just hope that you have, investments that are hopefully, improving your overall like dollar positions to make you some money. But I think the narrative of the Fed is, it was a really noisy year to have like Powell kind of adversarially, meeting to meeting and letting all the Fed speakers talk. There was a lot of dissent in the Fed this year, which is hard to follow. That was the most dissent we've seen really in the last like 30 years. But Trump didn't help. Powell like kind of stuck to his guns. But I think that ultimately inflation does matter. It's nice to see that things have been deflationary, or at least improving. Shelter's been a big component of it. If you look at if we have CPI data in Edgefinder and anything on shelter, 40% of our government printed CPI numbers are coming from shelter, and that has been improving. And so if grocery store prices are not getting worse, gas at the pump prices have been better, and shelter as a lagging indicator and one of the biggest weights of inflation is coming down, we should still see inflation numbers month after month as we get into the new year, hopefully going, sub 2.7, 2.5. Maybe we do hit the 2% target. But if we go to 3%, if we go back up to 3.3 to 3.5, it's going the wrong way. And I don't think that the rate cut is going to be the story. I think that the Fed has cut rates. We haven't seen anything change on the long end of the curve. It's only the short side. So the 2-year, the 3-month, the 6-month, but the 10-year hasn't budged. Inflation will ultimately drive the 10-year. And I think that that's going to be the story, man. It's like we can't really afford to see higher inflation, because if we do that, it takes away the power of the Fed to do anything that's not going to have, like, they're going to have to be restrictive if they want to tame inflation versus letting this market run hot. But it is a very, very like fine needle to thread, just because like the Fed wants to, kind of like politely support this market and politely support this agenda and this narrative to get like monetary and fiscal policy aligned. But if we, I hope we don't do this. I mean, I know it benefits a lot of people that need it, but if we send checks to households and it's another, $500 billion or $1 trillion, like basically dividend package or surplus package to households, how does that not equal more inflation? It's going to find its way into the markets. It's going to find a way into the economy. It's going to be a boost in the short term, but all it's going to do is drive prices higher. And it's like being penny wise and pound foolish. I just don't think you get the long-term benefits out of it, because eventually inflation will squash everything that's good about how far we run and how hot we run until it all comes to a crash.
Yeah, I would agree. And, to your point about just the inflation concept, by the way, some people asking about meeting minutes, just as a reminder, we say this every time, meeting minutes are not a Fed Powell speech. There's a very big difference. Meeting minutes are just a publication of notes from a private closed door meeting amongst the Fed committee members. We will be, as the moments roll on here, we are going to be giving you guys headlines on what's going on with that. Please stay tuned. It's not a live stream where we're going to watch Jerome Powell speak. I know a lot of people are probably looking for that. It's not what this is. The Fed meeting minutes are just a private closed door notes from meeting. Chris, if you have anything on your side, let me know. I'm going to also pull it up on my side, see if I can find.
I just posted in the chat there. Most participants judge further rate cuts would likely be appropriate if inflation declined over time as expected. So to me, it's all about the path we're on right now looks pretty good to continue to, talk about rate cuts. But we just cut, remember, 1.75% from the short end of the curve. The long end hasn't done anything to improve. So even if the Fed is going to cut more and more and more on the short end, I'm telling you that the US 10-year is going to be your barometer for whether or not the bond market, the yields, the cost of everything. If you are buying a house, if you're refinancing debt, if you are anything that's related to 5 and 10-year plus financing, this is your chart. Because if this goes up, things are more expensive. This goes down, things are getting better. If you want to see a boom in the housing market, you let supply catch up and you somehow see that house prices are coming down, or that 30-year mortgages are coming down. But if we go sticky up to maybe 4.5% again, 4.8 is kind of a breaking point. We've seen the market react there a couple of times. 5%, I feel like something's going to break. I think that's a levee. That's the crack in the dam that starts to let a lot of water out. I don't think that the 10-year gets above 5% without having some major consequences.
Sure.
So,
and
we haven't improved, man. We haven't improved at all since we started cutting rates. We cut 1.75%. So we cut 1.75%, and we are actually higher in the 10-year yield. So nothing is better from that standpoint.
Yep. We've got, so we're just reading off some headlines. Most participants judge further rate cuts would likely be appropriate if inflation declined over time as expected.
If inflation declines,
Some participants suggested that under their economic outlooks, it would likely be appropriate to leave rates unchanged for some time after a December cut. So it seems like, some push and shove here in both directions. Some people saying, let's wait for some inflation numbers to come in better than expected. Others are saying still room to cut interest rates. Not too much of a change here, just reacting to price action. NASDAQ, S&P 500, pretty unchanged. Dollar index slightly higher here. Gold, silver, pretty unchanged in terms of the 15-minute time frame, but still seems to be more of what we kind of already knew, Chris, in terms of expectations for rate cuts are still. I would say that the 2026 outlook for rate cuts is the next move is probably a cut. It's just a matter of how soon are they going to feel comfortable doing it. And it's also, a question of how dovish will the next Fed chair actually be?
Right.
We know that the Trump administration wants to put someone in there who's going to cut interest rates. But once that person's in there, their coworkers, their peers are Fed officials, and they're not, they're loyal to Congress. They're loyal to, supposed to be loyal to the American people. They're supposed to be loyal to their fellow Fed officials. So we'll see how much impact, the Trump administration because you got to remember, Powell was put in by Trump. And once in there, he's like, hey, we have a academic, job to do here. We have to do the right thing. So, I wouldn't be surprised if any, academic professional Fed chair in the running will probably be more dovish, and may lean dovish, but still will be bound by the same lock and chain that any Fed official or Fed chair is likely to be, which is the realities of inflation and the economy and, fellow Fed officials who they need to work with, not necessarily against, right?
Yeah. I also think that one thing, this is an interesting take on Jerome Powell. I think that what he did is he opened up the communication channels with the Fed. You saw more dissent. You saw way more Fed speakers going to their meetings and press conferences and fireside chats and this conference and this conference and this summit. The Fed talk was like all over the place. And why did it matter? Because it was such a big story around the political pressure that has been mounting in the Fed. The Fed is struggling to maintain this independence with, Trump basically trying to appoint who he wants. Again, what he says and does are two different things. Whether or not he really has the power to influence the Fed that much in its independence, we'll see. But the K-shaped economy, look, this political pressure is growing and mounting. The Fed does have an obligation to stabilize prices, try to do something to help the labor market, in addition to try to tame inflation. So whatever noise is coming from the administration on the fiscal policy side, look, I get that we need some inflation in order to still run the country. We can't have like disinflationary pressures and then expect to have GDP at 3 to 4% a year. It's not going to happen. So I just think that, again, man, it is such a slippery slope of, if we want to get to 3.5%, 4% inflation, look, we can have GDP at 3.5%, 4% to offset that. But my concern is that if we want to see inflation at 2% or sub 2%, there is probably no way that the US GDP is going to grow at 3 to 4%. I think we're going to end up like stalling. And, look, the Trump administration wants to run the markets hot. And what is scary is the last real history lesson that we had on that was back in the 70s. It was Richard Nixon and Arthur Burns. Arthur Burns was a Fed chair at the time, and there was a lot of political pressure that was mounting. And Nixon wanted to juice the markets and make sure he was reelected. And that led into a hyperinflation phase that Paul Volcker had to come in and squash. And that was a nasty recession. We raised rates to, double digits. I mean, in this day and age, like 40, 50 years later, I just think with the debt loads that we have, I feel like that would blow out the deficits even further. So I don't think we can really just do that. I don't think we can run this economy super, super hot. We can't run our debts up to 40, 45, $50 trillion without, again, like having the same conversation of where does this, kicking the can down the road ultimately have a reality check.
Sure.
And I don't know that. Everyone asks about debt to GDP, and the US is like 120%, and Japan's at 210%. So is there runway for us to keep just kicking the can down the road for another 80, 90% of debt to GDP? Maybe. But at some point, the bottom of the K, if the country as a whole is not improving, if the consensus and the sentiment is not improving, I don't see this, like, either we are just going to have the biggest inequality gap that we have seen in history and just keeps getting wider and wider, or something is going to happen that kind of breaks everything. And that is ultimately where like the consumer can broaden out, right? We talk about this market breadth and this broadening of the market. The consumers can broaden out because you can have a crush at the top of the food chain, but nobody wants to see that happen. Nobody at the top of the food chain wants to see their wealth hurt, and nobody at the bottom wants to continue to struggle. It would almost be easier to let this run hotter and somehow U-shape this to try to play catch up, and then you have people getting happier, I guess.
One thing, just based on what you said there, I'm going off the K-shape, how does that change? One thing that's kind of interesting is that there have been times in my own life, and I also have heard this from people who are, big notable market managers, et cetera. Sometimes the market will have this horrible week, horrible month, horrible year, and you go out into the real world and it feels like nobody cares.
I know. I said that to myself a lot this year, actually. We talked about this. It's like, I think we see this every day and every week, and it's like, are we reading too much into this stuff with like market? And it's like, people have life to live, and it's business as usual, and they don't care.
And the other reason is that most people are not invested as much as, the top end of people who are very invested in markets. So my point was saying that is your posture of like, okay, how does it reset? Well, people who are very invested because they have a lot of excess income, they have capital, they're in the markets, they could have a terrible week in the markets, go out to a picnic, and everyone else seems like cheery and normal because they're not benefiting or also getting destroyed by a market move. So I think that the wealth effect, it goes both ways. People who are, who have been very long the stock market and just, you're buy once every month, put a part of your paycheck, 401k, auto draft, those people, they feel great. And then they will also feel bad when the market comes down. But the people who are not doing that very much, they, when the market does drop precipitously at some point, we don't know when, but when it happens, right, they're just going to live their life as normal. So it's sort of, that's how it may reset at some point, is when you do truly have the big sell-off in stocks that lasts. Some people will feel it tremendously, and other people will be like, this didn't change, or honestly, it's great that the stock market's dropping, maybe I can buy some stocks cheap, maybe I can buy a house cheap. So yeah, I mean, I think that's how it happened in the Roaring 20s, Chris. I mean, it was a pump up for a decade. It was a massive inequality, home prices, stock prices, everything was pumped up on margin, and people were doing really well. And it lasted for a long time,
Roaring
before
20s,
a very long reset, the 1930s, 1940s. So
and we're not that far away from the old 100-year milestone of the Great Depression. So maybe this is the Roaring 2020s. That has room to run to 2027, 2028 before maybe a reality check. And again, it's like, just like we've always seen, you've got to give the market the credit that it deserves for trying to just navigate its way through all the bad. Yes, at crazy high valuations and historically high valuations, we're going to see a flinch in the earnings story that at some point will drive markets lower, because we are heavily concentrated in Mag 7. I do think that the CapEx spending is starting to, what would you say this, Nick? Would you say that CapEx spending is a bit on the irresponsible side at this point? I mean, it didn't take long to realize, like, there's debt now swirling around the CapEx spending for AI.
I would say
that does make, that does concern. Yeah, this concerns me for the next, 2 to 5 years. I think that I think I caught a session with Tom Lee this week, and he did say that in order for the stock market to still have like a basically backstop or supported level, we have to see the AI story continue to be optimistic. If everyone turns their back on AI, if everyone just all of a sudden starts to hate on AI, if this is completely hypothetical, but let's say that we spend the next 12 months building out all these data centers, and then people just try to burn these data centers to the ground. I mean, I don't know what that looks like, but when you have Sam Altman that says, I don't care if we have to raise 5 billion, 50 billion, 500 billion, I don't care. It's like, that's not really a plan, right? Sure. Like, that doesn't seem like a leader that can put numbers to work and actually have a plan to how to monetize that. Instead, it's like raise, spend. And that's like the underpants gnomes in South Park, which is, step 1 is build AI data centers. Step 2, step 3, profit. And we don't know what really is step 2. We don't know how we monetize that when you're talking about making, $20 million or $20 billion in revenue for $1 trillion in spend and debt raise. That's not a good investment.
I think Chris, to your point about the CapEx spending impressing the market, you're in a 4th year of a bull market now that was started by ripping us out of the 2022 lows through AI, right? So this whole thing has been hype around AI. I think that the longer this goes on, the more likely it is that people are going to say, okay, that effect, the newness effect, is worn off. We've all had ChatGPT for a while. We have all seen it. It's indoctrinated into all of our worlds, but people are going to start to say, where's the ROI? And we saw Meta get punished big time for, issuing
Metaverse.
More spending, right? And so I do think personally that if the market is going to continue, yes, you do need tech, you need AI to still be supported. I don't think you can have the stock market continue to move higher without it. But I do actually like the idea of small caps. I mean, I know that's I've talked about this a lot, but I like the idea of maybe the RSP, the IWM, rotation, international. I think just going in and just saying the same trade is going to keep, outperforming to the same magnitude, I think it loses its effect over time. Now, again, I'm a momentum trader, so I'm going to, trend follow what's working the best, but I actually see some divergence that I haven't seen in a while, Chris. I don't know if you've kind of picked up on this, but look at like RSP, Dow Jones, IWM. These charts look better than the Qs, right? So just from a technical clean breakout perspective, here's NASDAQ, right? Kind of range bound. Take a look at the Dow Jones. Dow Jones near those all-time highs. S&P 500 near those all-time highs. RSP, which is equal weighted S&P 500, pretty close to all-time highs. I think we're actually seeing some encouraging signs of participation broadening out in the market, and maybe some diversification away from just being long semiconductors and big tech companies. So, and I think that's encouraging. That actually, if you get the consumer coming back a little bit better next year, maybe short-term interest rates do come down. That is still I know we want it to ultimately factor out into the long end of the curve, but short end does still help. Maybe the consumer can get a little bit of a boost from, lower credit card expenses, 5 and 7 year auto loans, those sorts of things coming down. Maybe that helps out the average stock in the S&P 500, rather than this story of big megatech companies that are so well funded they don't really care what interest rates are doing. I think that's why you've had such concentrated outperformance, is because people have said what you pointed out earlier: interest rates haven't really budged very far. Smaller companies and growing companies, they like lower borrowing costs, and we just haven't had that. So that's my thought, is I think you could see a broadening in 2026.
Agree. I'm looking at a trade right now on small caps. It's a little bit longer. Like if I went out to January 2027, I give this trade basically a year. 180 by 170 ratio spread for $200. It's an income trade. I'd be willing to take on ownership of the Russell. If I wanted to tighten this up, I can probably put in a defined risk trade, but still be willing to own shares at 170. My break even would be 158. So if I get assigned 170 minus 10 minus 2, I own the Russell at 158 if I'm assigned, and that's a big if. Obviously if the Russell goes higher, no harm, no foul. But if we come all the way down and I get assigned, I'm owning this thing at 158, which is a 36% discount. If things get really bad in 2026, small caps could be down 60, 70%. Yeah. If things are, the one thing with earnings is, S&P earnings at 24, 25 times earning right now in the PE. If the small cap side, which has a crazy expectation of like 59% gains on, not like the index doesn't go up 59%, but as far as like earnings growth, it is like 3 or 4 times the expectations of the S&P. Even if we come in mildly accurate, then the Russell is probably going to drift higher. We've had that large cap versus small cap for a long time. If the Russell catches up and the S&P and the NASDAQ kind of stall, the outperformance of the Russell could be really good. I've mentioned this before. I am putting in a decent position on non-US plays for 2026. I think as an allocation, I've got to have some non-US, because we could have the US, let's say, do.
Where are you going, Chris? You going China, Brazil,
everywhere.
all of
I've got Brazil, Latin America, and Europe and China are my main ones, and there's some India exposure in there too. So SCHY is a good way to do that, and then I'll just type this up. So SCHY, EWZ, and ILF. So that is Europe, China, India, and anything non-US. It's like a basket of like 200 different non-US plays. You can also trade the MIXI, like SUX, but I like the SCHY one because it's only like $29. Brazil is EWZ. Latin America is ILF. I think that, some of our closest neighbors, like, improving terms with Canada, improving terms with Mexico, trade partners in Central America and South America. Who knows, man? Like this side of the world, it's like if the U.S. wants to increase its footprint and start having, Central America, South America build data centers, and all of a sudden we have like an energy play in other parts of the world that we have a footprint in. I could see like the terms of this benefiting these countries in a big way. Europe as a whole, it's like this was the year to do it. I didn't do it because I didn't care about the pigs of Europe, which would be like Portugal, Italy, Spain, Greece. They've been up like 40, 60, even up to 80% gains in just a single country ETF. That's a great one-time play, but there was no way that I would say I'm going to keep doing that for 2026. I will say another continent would be Africa, which again, like super low valuations, and
how do you invest in Africa, Chris? I was talking to James in the office about this. I was like,
I think it's AFK.
I think they could move some manufacturing there, but I don't even know an ETF for it.
It's this one, AFK. This is the one that I trade.
Okay.
It's Africa Index. It was up year to date like 70 or 80%. Yeah, 70% year to date. And what's crazy is this run is not even at the like the average price of earnings is like 11 and a half. And even with this 80% year, we're still trading under that price of earnings average. So there's still some juice left in this thing. And, you know, I mean, look back on the chart here on the weekly, you know, even if we are going to go up to 35, let's say that we just get back into the structure. Let's say we make a run to these highs when it first started back in 2008. Even this run right here is 26% for the year. As an index, it's like, well, that might beat the S&P. If we go up to these highs again, that's 58%. That kicks the pants out of the S&P.
Here's another one for you, Chris.
Okay.
VNM. It's Vietnam.
Oh boy.
Kind of an interesting concept.
Okay.
This year up 60%, 66. Sorry, monster move. Part of the excitement around this, you can see it was in April, big sell off with all the tariff tantrum stuff.
Right.
But then it seemed like Vietnam 91%, actually 93% from the lows in April.
That peaked in October.
That
was a quick run. Yeah.
And which is basically the idea is like, okay, we've got a potential winner in all of the tariff uncertainty with China, with all these other countries. Vietnam seems to be kind of a U.S. favorite in some ways, at least what the chart's telling you. So maybe some manufacturing.
Go to a bigger time frame. Go to a bigger time frame. That thing is like potentially just getting started.
Yeah, take a look at your monthly.
Yeah, I mean, so could we go from 19 to? I mean, could we go to 28? Sure. I mean, it can keep going. I mean, I'd like to see a dip or a pullback, but if there's like a bull flag base where we started at 10, ripped up to 20, we have like a $2 to $3 pullback. But if we break that $20 high, I mean, measure the move. Let me just kind of box this in. If we measure the move, let's look at some symmetry here. So let's say this is lows, and we break out and kind of double this move. Project this thing up to around $29. And even if you bought it right now at 19, here's what I would do. If I like this trade, I put in, let's say $1,000 here, $1,000 at the halfway point, and $1,000 at the bottom. I'm all in for $3,000. If my cost basis is in the middle, around $14 or so, and we get up to these highs, that is a 100% return on capital.
Sure.
If we just get the measured move, like I talked about, even if you put a small position like $1,000, that $1,000 is paying you $500. Like that's 52%, man. Like that type of stuff. I think in this whole idea of the U.S. can be great and the U.S. can be resilient and the U.S. can be, you know, the most liquid economy in the world. I understand that, but the U.S. can also underperform things that it has been destroying and dominating for the last decade plus. It's like money is coming home. Yep. This repatriation is a real thing. When if governments around the world are going to spend money to run deficits like we have been doing, we've generated a ton of wealth doing that in our countries, and our you know, performances have been off the charts. But if there is a rotation where it's like, hey, we'll just do the same thing the U.S. is doing, and they just want to do it for themselves. If countries try to enrich themselves, like these ETFs have a long ways to go. So it could be an interesting, you know, maybe a couple of years where maybe the U.S. is stable, but the U.S. gets outperformed and kind of lapped around by making up some of this, you know, outperformance that it's had for so long. It's like that. What do they call it? American exceptionalism, right? American exceptionalism, where it's like the U.S. is just above and beyond everyone else. And keep in mind, like it is very liquid. There's not much you're going to do on these ETFs outside of, if I put it in as kind of a basket trade, I'm probably going to allocate something close to like $10,000 or $20,000. That is it. And that's going to be about a 5 or 10% position overall. And that's going to be a mix of non-US allocation. So
yeah, I mean, I don't hate it. I think the idea of you know, for listeners who are like, no, you know, US is just superior. Well, what you could do, totally, you know, not financial advice, your total choice, but you could also consider the idea of allocating some. You could still say mostly US if you wanted to, and then allocate in some other places. You could allocate heavy to precious metals. You as the trader, you have the special ability to allocate how you want, right? You don't have to necessarily be all in on one thing. And in fact, you know, historically speaking, being all in on one thing is where you get the biggest drawdowns or the biggest gains, right? Diversification is a double-edged sword. It spreads out your risk, which it can be better when, of course, you know, everything is kind of fallen and you're diversified, as opposed to being concentrated in tech stocks. If they were to drop, you know, 50, 60% next year, right, you'd be looking at a rough ride. Chris, we've been going for a while. I think we could probably call it good. I know you've been streaming since 1 o'clock, so you've been on for a bit. Before we leave, guys, if you're interested in getting access to the trade alerts being shared by Chris or myself, every trade that we take gets shared inside of our Discord server. If that's something that you're interested in, we'll drop a link here to where you can speak directly to a member of our support staff to get access to our trade alerts. If you need a copy of the Edge Finder, our holiday sale is ending tomorrow. It is currently 40% off. Easiest way to get access to our tools, signals, etc. Just send us a direct message using the link that's just been dropped in the chat here of the live stream, and you can connect to a real person on our team. Okay, Chris, thanks for coming on, man. Great conversation, and looking forward to 2026, man.
Same here, man. All right, talk soon. Happy New Year.
Right. See you guys.
Bye.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.